Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights that boost your trading potential. Coming up, U.S. markets looking for a rebound after yesterday's sell-off. Investors are assessing whether the recent pullback is a healthy correction or the start of something more significant. Fairfield Strategies' Will Tamplin is going to break down what the charts are saying and where he's seeing opportunities outside of big tech. And later, Amazon has pulled back from its recent highs. We're going to break down the outlook for the stock and walk through option strategies for both the bulls and the bears. That is all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. The trading day. Let's check on the S&P 500. We have some green on the screen in the early going, despite the fact that tensions continue to flare in the Middle East. Wholesale inflation in the U.S. came in hotter than expected. That's after headline inflation, the CPI print, came in at a 3-year high the other day. And yet we still have a bit of resilience in these markets, although we have been selling down over the past couple of days. And yeah, some interesting dynamics right there. We're going to dig into it. And of course, the markets are awaiting the SpaceX IPO tomorrow. There's a lot going on. Let's jump into the heat map. I want to see where the movement is, the push and the pull. And right now, if we're looking for green, it's some of the names that got hit starting last Friday with the sell-off and has been choppy all week. Nvidia is up modestly, but Micron, Broadcom, a few other names are moving higher. Oracle, though, let's take a closer look at this one. The tech giant is under pressure. It was down nearly 8% in the pre-market today. Of course, AI, they can tell you that, that's going well, but the billions they're spending, capital expenditures for those data centers and everything else is taking the market back a little bit. Planning to spend $70 billion in its 2027 fiscal year, and that is definitely raising some concerns. It's probably a story we're going to tell about Amazon a bit later in the show as well. And that's your market update. Joining me now is my colleague Hiran Amin from our direct investing educational team, and Will Tamplin, senior technical analyst at Fairlead Strategies. Thanks for joining us, gentlemen. Before we jump into the conversation, just want to remind our viewers that the views and the forecasts expressed are solely those of Will and his team at Fairlead Strategies and is based on their research. Will, we have seen a sharp rebound in these markets from the spring lows, and we've hit a bit of a choppy pad, a bit of a perhaps a rethink of this tech leadership. Is this a healthy pullback, or is this the start of something a little more concerning?
Yeah, so we think it is the start of something a little bit more concerning, at least in the short term. So we've been watching short-term trend following gauges like a 20-day moving average. And in steep uptrends, we like to keep the slope of that moving average on our side, and it's actually rolled over starting earlier this week. It began to roll over, and so now we do have sort of short-term risk to the downside. For the S&P 500, we're initially watching the 50-day moving average, which is nearby. It's right around 72.30. We think that is a place where we can get some brief stabilization. But ultimately, we are expecting a corrective phase for this market to keep hold over the next few weeks. And then ultimately, we do think that 50-day moving average is vulnerable to breaking, and there's stronger support for the S&P 500 around 7,000. So certainly some more downside potential just based on the loss of momentum we've seen.
All right, Will, if we're talking about more downside potential for the broader market, we got to talk tech. I know you're watching it carefully. What are the charts telling you with the AI and the semiconductor trade right now?
Yeah, it's really more of the same. So really when we see the leadership start to crack, that's a concern, a little bit of a sentiment shift in our view from what we've seen over the past week or so of trading. With the semiconductors really leading on the downside, they had led on the upside. Really all the way from the early April or late March bottom. So that is a concern for the market when you lose your leadership like that. And really market breadth has been somewhat improved, but still somewhat lackluster in a way. So we don't really have the support from a lot of the other participants in the market in terms of momentum. So that is a risk for the market.
Well, I want to go back to talking about the pullback we just mentioned right now, and if the tech charts are sort of flashing yellow, where exactly are you drawing the lines on the S&P 500? I know you mentioned the 7,000 is that key support. So is that the level that either has to hold the bull case together, or is going to break it, or is there other levels that you're considering?
Yeah, so I think that the 7,000 level, it's always important, I think, to hold up above a former high. Um, certainly it wouldn't break the long-term uptrend if we took out 7,000. We would still be in a long-term uptrend, but certainly if we took out 7,000, we would be talking about a more significant, more intermediate term type of down move. Whereas right now, I would still classify this move as more short-term counter trend type of pullback within the context of a broader uptrend. So I think if you start taking out support levels, if you start breaking support levels like 7,000, I think it just prolongs and deepens the corrective phase. And so I'm just thinking about it in terms of time horizon. If we start to break levels like that.
Okay. And then, we obviously have to talk. We're in a period of volatility with different macro themes and geopolitical tensions building up. The fear gauge seems to agree with some of the caution. In your latest report that you've come out with, you flagged a breakout in the VIX. Now we've seen volatility spikes before that have fizzled quickly. So what makes this one sort of different, and how seriously should investors be taking that signal right now?
Yeah, I think they should be taking it seriously. It is a short-term shift in sentiment. So we saw the VIX get a little bit more suppressed. It came back down towards support, sort of in the mid-teens, and now it's lifted off of that back above 20, back above the 50-day and 200-day moving averages on the VIX, and that generates a target of roughly 30, just north of 30, where we've seen previous peaks on the chart of the VIX recently. So yeah, I mean, in terms of market sentiment, when you see it get somewhat complacent and then you see renewed momentum behind the VIX, it does create near-term risk, and it's a reason why we are telling clients to use any kind of strength off of the 50-day moving average in the SPX to get hedged over the next few days.
Well, when we think about when we get pullbacks like this, people like to throw the term healthy in there, particularly if they're talking about a rotation. The criticism is that stocks tied to AI and tech are leading the market. Are you seeing what we could call a healthy rotation, something to hang our hat on?
Yeah, I think that it's encouraging to see breadth improve, and some of the other sectors participate really over the past week as this pullback has happened. It's really been mostly concentrated in the tech and AI trade. I would say at the same time, though, the problem is that it hasn't really been enough to like the advanced decline lines that we track, cumulative advanced decline lines. They're still below their highs, and really a lot of sectors still have weak momentum from just like an intermediate term perspective. So it hasn't really generated like a meaningful shift, bullish shift in a lot of other sectors. Certainly, we can get relative performance though from other sectors as tech kind of drags these major indices lower. I would expect during a pullback for more defensive leaning sectors and even some of the cyclical sectors to outperform relative to the benchmark. So, when we think about areas to take profit and reduce exposure in anticipation of a deeper pullback, we want to go to the former upside leadership, the higher beta technology names. Those are the ones that are most at risk and worth taking profit.
Well, let's actually break it down into sectors. Speaking of healthy, you've actually upgraded healthcare to overweight. Not exactly the sector that gets the crowd on their feet. So, what are the charts telling you that makes this the quiet winner right now, in your view?
Yeah, so we have short-term breakouts in both price terms and relative terms for the healthcare sector. If you chart something like an XLV or just the S&P 500 healthcare index, we have breakouts above 50-day moving averages in both absolute price terms and relative to the S&P 500. So we've seen momentum shift off of an oversold after being oversold. We've seen momentum improve now off of that condition, and it supports additional outperformance from healthcare, which contributes to our overweight stance. And that's really a stance that has intermediate term shelf life, we think. We've seen some of the big pharma names like Eli Lilly break out, and also Johnson and Johnson as well. So some of the big heavyweights in that space are doing well and doing a lot of the heavy lifting. And breadth, even under the surface, has improved a little bit for healthcare as well. So that is certainly a sector that we like, and a place we think people can hide over the next few weeks.
Will, when it comes to the price of a barrel of crude, it's been choppy. I think given what's happening in the Middle East, some people might be scratching their heads as to why West Texas Intermediate is below $90 a barrel, but you've also upgraded energy. What's the thinking there?
Yeah, we do have an overweight. We do have an overweight bias on energy. Crude oil does have support right in line to where it's trading right now in the high 80s. It's been able to bounce in this area around 88 a few times. It's certainly been choppy for crude oil. We have seen somewhat of a loss of momentum just as a function of the range-bound price action over the past several weeks after the spike higher. So expecting more short-term volatility to the upside and downside in crude oil. And then the energy sector specifically it's a relative call, the overweight call. So it's short-term oversold versus the S&P, so showing some signs of downside exhaustion in the ratio of an energy benchmark to the S&P 500, and we do think that it's due for a relative rebound, so outperformance over the next few weeks or so. And then longer term, it is improved as well. The energy sector, we saw XLE break out to new highs earlier this year. So certainly a broader uptrend in place for the energy sector in general.
Well, I'm going to turn to another corner of the market that you've been watching, and that's the bond market as closely as the equities space as well. The 10-year yield could push up to 4.75. That's a level that's rattled markets the last time we were there. Why is that number such a critical threshold, and what does it mean for stocks if we get there?
Yeah, so for the 10-year yield, that 4.75 level is where we topped on 10-year in 2024 and 2025. So really an important threshold on the chart, where we would expect yields to, if we got there, we would expect yields to, meet or bond prices to lift, and for yields to decline just because of that recent pressure at that level. Certainly, if you were to break out through 475, that would be a major macro shift. We're not expecting that yet. We would still have a long-term neutral bias while we're in this range below 4.75. So that's really the top of the range, 4.75. It's an important level for the markets macro-wise. And while we've been in this range, equities have done pretty well, over the past 3 years. So I think that for equity investors, staying in that range is a good thing for the long-term uptrend in the S&P 500, just keeping it more of the same. And we do think, though, in the short term, as we expect equity volatility to pick up, Treasury yields we think can move higher over the next several weeks into midsummer towards that 475 level, and that could be a short-term headwind for stocks.
Well, next week, of course, we get a Fed rate decision. It'll be the first full flavor of the Kevin Warsh Fed. How much is the Fed driving the bus right now when we look to the bond market and yields? How important will their influence be as policymakers?
Yeah, I mean, it always has influence, especially on the shorter end of the curve. So once again, I think that our short-term indicators suggest that the 10-year yield bias is higher as we go into the Fed meeting, which is interesting, with room up to that 4.75 percentage. So we're not expecting a turning point lower around the Fed and 10-year yield. We think it's actually the opposite. We think it could go higher around the Fed, surrounding the Fed meeting. And certainly the Fed policy is critical for interest rates, and it's always something that we have on our radar, the 10-year yield and the whole curve really when we get to these Fed meetings. So we'll be watching it closely, certainly. And then I would say the other thing from a macro perspective that's huge right now is the dollar index. That's another big one that can be impacted by Fed policy. And so we're watching the dollar index test key resistance, psychological resistance around 100. And that's important. If we break out through 100, that would be a big base breakout and suggest we're in a cyclical uptrend in the dollar index. So that would be certainly a shift, a potential shift that we're watching with this Fed meeting on deck.
Well, let me actually pick on that for a moment, talking about the US dollar index there. I know everyone's got their eyes on the Fed next week, but given that level that you just mentioned, the $100 level on the US dollar, which seems to be the line in the sand, why is that threshold matter so much, the $100? And what is the implications of some of the other asset classes if we do see the dollar sort of gain into strength coming into this Fed meeting there?
Yeah, it's just where there have been. It's just a relevant level where there's pivot points on the chart of the dollar index. If you look back several years, really over the past few years and over the past, I would say, year, we've seen several. I think we've seen 4 or 5 peaks where the dollar index has bumped up against 100 and pulled back. And so obviously, if you broke out through that 100 decisively, it would be a shift in character and suggest we now have a new uptrend in the dollar index. And if that happens, my mind immediately goes to international markets.
Yeah.
International markets typically, at least in relative terms, they like to see a weaker dollar. So if the dollar were to break out to the upside, I would expect international markets to struggle relative to the U.S., to lag the U.S. That's where my mind initially goes, is internationally and thinking about other currencies. And then also it can be it might slow down the pace of this uptrend in the U.S., the long-term uptrend. If we get more sustained dollar strength, it could generate just more choppiness and volatility in U.S. stocks too. Global risk-off conditions tend to be associated with a strengthening dollar.
Will, before we let you go, I'm going to give you a double-barrel question, something I was taught to never do as a journalist. But first, I want to ask you, what's the one chart you're watching right now that isn't getting enough attention? And then what could actually challenge your thesis around healthcare, around energy, your call right now in the markets? But let's start with the one chart you're watching.
Yeah, I think the one chart, individual stock-wise, that I'm watching is Johnson & Johnson. We have to be selective with new exposure, just given the top-down risk that we've seen and the volatility that we've seen resurface for equities more broadly. So going to the healthcare sector to source a name that has a new catalyst, so a short-term breakout, completing a short-term double bottom pattern. So we saw Johnson & Johnson successfully retest support right around 221, and now has a positive shift in momentum if you plot a daily MACD onto the chart of Johnson & Johnson. So I think there's room on that chart in the short term to get to 252, which is the former high. We've seen Lilly make a new high, and we've seen broader pharma benchmarks make new highs. So I think Johnson & Johnson is next up to do that. So that's the one individual stock chart I would watch. And then in terms of what could prove the thesis wrong in terms of healthcare and energy, I think it's just I think it would be the AI trade really just quickly reversing and ripping to new highs, and we have to watch out for that. So certainly we can watch some like the slope of the 20-day on the SPX. I mentioned that it turned lower. If it quickly were to whipsaw higher, or if we saw the S&P 500 break out above 76.18, which is the recent high, those are signs that some of those more defensive sectors, in a way, or risk-off sectors, the overweight call in those sectors I would call that into question if we were to break out in the S&P.
Will, great insights. Really enjoyed the conversation. Thanks for joining us. Hope you join us again soon.
Thank you for having me.
That was Will Tamplin, Senior Technical Analyst at Fairlead Strategies. And just a reminder to our viewers that the strategies and securities that are discussed on our show, educational purposes only, should not be considered investment advice or buy, sell, or hold recommendations. Lots of interesting stuff there here. And I'm going to pick up on, perhaps go back a day. Yesterday, you were doing your technical analysis, your technical take on the noon show, and you're talking about the fact that there's still a bearish tilt in the S&P 500.
Yeah.
Will is agreeing with you. He talked about, breadth improving, and we like that, right? The healthy rotation, that idea that we see in the pullback. Maybe this is all healthy, but he said it's not enough right now to get a bullish shift in some of those other sectors. So you guys seem to be singing from the same hymn book.
Yeah, we certainly are, Greg, of course. So it validates what my thesis is obviously heading out to. With S&P 500, he mentioned the 7,000 level. That's the level that I've also been looking at. That's going to be a decisive level. We're not there yet, but we are sort of slowly inching towards that, especially with the volatility shakeouts that we've had. But another thing that, Greg, that you have to keep in mind is the Dixie. I know that's sort of in the back of everything so far. It hasn't moved at all, but it suddenly started getting to that 100 threshold. And that's kind of what we call a base level there. So any break above the 100 and sustained move staying above it, that strengthens the US dollar, and that means that any companies that are going to be more export dependent are going to have more volatility in the earnings because of a stronger greenback currency, and that also can shake up the equity space domestically over here as well. So that is one to keep an eye out. And then, of course, we know the bond markets. We'll see if the bond vigilantes are going to really come out with pitchforks, depending what the Fed says and what the tone is next week. So that's another one to keep an eye out. They've obviously started voicing their concerns in terms of how the yields have been moving. We thought the 30-year, not even the 10-year, the 30-year, the longer term, break above that 5 level, 5.2% just briefly last week there. So another one to just keep an eye on as all of this shakes out in next week, and we'll see kind of where everyone is putting the cards down on.
Lots of interesting stuff there. Never a dull moment, lucky for us. If you at home have a question for our guest or our team, here's how you get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website where you can try out the platform risk-free. Open a practice account by clicking on the Try TD Active Trader button. Then when you're ready to switch to a live account, simply export your workspace and start trading for real. Time now for Technical Take, and the stock in the spotlight is Amazon. Investors, of course, well acquainted with the e-commerce giant and its multiple growth engines. We're talking Amazon Web Services, the ad business, shipping logistics, artificial intelligence infrastructure. There's a lot there, but with all that growth comes some pretty big costs, and the stock is off its recent highs. So, what are the charts telling us here, and what are you seeing in Amazon?
Yeah, Greg, it's what you mentioned at the end there. There's a lot of capex spend that Amazon's planning to do. Obviously, they've committed to $200 billion this year. But one thing I wanted to note is, a couple of months ago, we saw Google dip into the bond market and actually start issuing bonds in different currencies, and they notably did it in Canada. Well, guess what? Amazon followed the same cue card, and they just sold $14 billion of Canadian dollar high-grade bonds. This is the largest corporate debt offering on record in Canadian dollars. That is drawing about twice the amount in demand. So there's about a 28 billion sort of demand in this. So very popular. So it just sort of sees that they're tapping into international markets now to raise the capex that they need to foray into this space in AI and do the build-outs that's necessary. But the other big news, Greg, we know that this week that we know they're a big logistical company, but they're now extending that logistical business outside of their own organic business itself. They're opening it up to other U.S. businesses in the light than or less than truckload freight arena. And this did sort of shake up some of the common freighters that we know, FedEx Freight, Old Dominion, XPO Lower. But the one thing you have to understand with Amazon, it is less than a truckload freight, which means it's about 5 pounds or less in packages that they would do. So they're not going after the entire freight market. There's a very niche segment of that market. They're going expected sort of, it's an $80 billion transport market that they're looking to get a small slice out of there on their cards to just see if they can do a turnaround besides the AI. But if we go into the charts, Greg, let's see what's happened so far. So we're just going back into last fall and the start of this year. You can see one thing I just wanted to cast everyone's mind to on the charts first. We saw Amazon kind of top out at this 250 level for the heading into the end of 2025, into the start of 2026. This was a key level. It was not able to break through. We did see that big shakeout in February. We saw the collapse in the price go all the way from that 250 high and touch and tag that 195, and this ends up being the low on the 52-year, in fact, right at this 195 level. We did see it kind of bounce up, and then after the sort of Iran war tensions were abating, we did see that big move up here. That actually propelled it to a kind of a new high that it's hit in the 52-week, and that's at this 270, just above that 275, touching close to 280 over here. What this has done, though, in the near term is formed a double top pattern. So we topped out over here. We had a second top out here. This means that this 275 level is a key resistance on the higher end. But since then, we have been sort of in a corrective phase, pullback, and we're into this demand zone between the 235 and 238. This is key. And one thing I wanted to point out, to our viewers is we've seen a lot of bearish activity. You can see based on these big bodied bearish candles, a lot of selling pressure coming into this. This is the key area that I'm looking at right now, the 235 on the lower end of this zone. This is supposed to be a demand zone typically where we've seen buying activity sort of stir up again. But if it fails to hold this and cracks below, we could then test support at the 215 level. Now, one thing we also look at to just further confirm this bias that we have, Greg, is the double top pattern also informs us what the possible move could be by looking at the peak to the trough and measuring that out. And I've got that measured move plotted over here. And that points to a $25 sort of drawdown based on the 250 resistance price. And that means maybe just 225 could be the pressure that we see if it does break below this demand zone that we have. Right now, the momentum is in favor of exactly what the bears are doing. You see RSI kind of hitting that oversold territory. Hasn't quite crossed into it, but it is in the 32 level, which does indicate bearish sentiment, and so does the MACD just getting to that negative territory there. So right now, squarely, seems to be the bears are winning this tug of war at the moment.
All right, a very interesting chart there. I see even a very dramatic chart. Lots to watch there. Now you're going to walk us through a couple of ways we could trade Amazon. Before we get started though here, I just want to remind our viewers that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. I'm going to take a wild guess here and think you want to start with the bear thesis.
Let's start with the bear thesis. You got it exactly, Greg. So I'm going to pull up another chart and I'll just draw up where our bear thesis stands on this one here. So let's try this one more time. All right, here we go. So if you prescribe to what I've just shown on the charts and we expect the move to come down to at least that 225, possibly test that 215 level, one of the ways you could do it, a trade, is a butterfly put spread strategy. Essentially what this is, we want to look at the implied volatility profile there. It is kind of on the lower spectrum of it. Expected move that we're aiming for with the time that we're giving ourselves, roughly about a month and a half, is about $22 on either side of where the stock currently sits at. So how the strategy works, Red, it is composed of three option legs. So the first leg would mean we're buying the 235. That's slightly just outside of the money at the moment. We're going out to the July 24 cycle to buy that. Then we're going to look to sell 2 of the 215 strike puts. Now, this is a key level. Remember, this is where our support was, our key support level at 215. This is why we're selling there, because we expect if it does come down to that level, there's some buying activity that will come up to support the price there. And then to cap it off, we're going to be buying out the 195, so we cap off any risk over here. Now, Greg, this one is an equidistant trade. It's $20 width on either side, which just makes it a pure butterfly. We haven't broken any wings over here. And the cost for me on this one is going to be $4. And this is the whole reason of why we do this trade, is to really reduce that cost if we're looking for directionality on the trade. That means my break-even's at 231. I need Amazon to break below 231 to start being profitable in the trade. And then there's another break-even we've got at the 199 level. If it crosses below this, we start losing money on that. And I do have a reveal there for you.
Let's see the reveal.
All right, so let's actually go and break down the numbers. So where do we stand in making the max gain? Well, this is almost like trying to hit a bullseye in a sense, because if we intend to hold it all the way till expiry, I pretty much want Amazon to take a break and stop at this 215 level. So if it does that, we stand to make $16. That's simply taking the width minus what we're paying, $4 in this case. However, if it starts going below that 215, it starts eating into this profit. So we're not losing this profit, but we are reducing that profit until it gets to 199. If it gets to 199, then it wipes out any profit that we have and we start taking losses on. But again, our max loss is always going to be capped at the $4. That's what we spent into the trade. So if it goes all the way below the 195, then we still only end up losing the $4 in either case. So if it goes either 195 or lower, we lose the $4, or if it remains above 235, we lose the $4 that we put into the trade there.
All right, interesting strategy there on the bear side. What if someone's just bullish on Amazon?
All right, so if we're playing bullish strategy, one of the ways we could do this, Greg, and this I'm kind of a proponent of this, because if you do have a stronger long-term thesis on Amazon, maybe you're looking to acquire the stock at an attractive price, one of the strategies you could do is a short uncovered put strategy. Now, this is uncovered, so it does require margin on there, and there might be significant margin depending on how many contracts we do. For our conversation purposes, we usually just stick to one contract. And we're looking to sell the 215 We're going to go all the way to the August cycle, so we're giving ourselves quite a bit of time. That's roughly about just shy of 90 days there. And we're looking to get in at $8 credit. So we do want the stock to start moving meaningfully down. And so the credit's not there yet at the current market price. So $8 gives me an attractive risk to reward profile on the trade. And the way this works, Greg, is so if we do collect $8, that does mean that our break even is at 207. So if it does happen to break below 215, we're still okay until the 207 level over here that we have. Now, let's do the reveal over here.
The risk, you do have assignment risk here, right?
We do have assignment risk, and that's exactly what this trade is about. So let's talk about that first. So if it does break below 215 and we still hold the option position, of course, the one big risk we do have is assignment. In other words, we are going to have to pick up 100 shares of Amazon at 215 apiece. Now, the worst case scenario is also in theory that the stock could actually, fall flat on its face and go down to zero. That means the total loss in theory would be $207 because that's our break-even price. You times that by 100 shares, that equals to 20,700, and that's where this number comes from. Our best case scenario, though, is this is where we're neutral to bullish on the stock, is that if we do expect it to fall, we don't expect it to fall below 215. So as long as the stock stays above 215 or higher, we get to walk away clean and clear with our $8 that we have, and maybe a few fancy lunches in the bag if we can snag that as well. That's part of it. So that's the reward there.
Interesting trades as always. Thanks for that. That is the show for this week. As always, investors should perform their own due diligence before engaging in trading. We will be back on Tuesday. And what are we debating? We got pretty close to the name here. What are we debating?
We did. I'm trying to recollect what name did we have over here, Greg.
They say it's FedEx. This is sort of taking me by surprise too. It is FedEx, yes, right? Control room? It is FedEx.
The Freight Wars. Yes. Yeah. There's a reminder. I was going to jump to Micron, but that's not coming up anytime soon. But FedEx is what we're debating, of course. FedEx, notably, just last week had spun off their freight business. So this will be an interesting to look to see, especially with the Amazon news that we just covered and a new entrant coming and giving some competition how that overall stack looks. So that's what we have on queue.
I just know right now our producer Alicia's going, you guys were both in the meeting. How could you not remember it's FedEx? Alicia, I will pay more attention in our show meetings. But that's all the time we got for today. Thanks for watching, and we'll see you next Tuesday.